Hi Nathan, can you tell me what do you predict the economic situation of Canada in 2019?
Our view has been that the economy is still doing okay. So GDP growth data has looked pretty soft over the last couple of quarters, but we still think you can trace a lot of that weakness back to what we think will ultimately be transitory softness in the oil and gas sector and some bad weather effects. So excluding those temporary factors, economic growth still looks okay. So, not at kind of the stronger pace of growth that we've had in previous years, but growth in the range of 1.5% to 2%, which is kind of a sweet spot for the Canadian economy. So growing fast enough that the unemployment rate doesn't rise. And that's not really a bad thing at this point because it's already historically pretty low.
Okay, so what's the main elements which will affect the economic situation of Canada in this year?
Well, I mean, one of the big ones I think is how the trade tensions between the U.S. and China ultimately play out, and that's one of the risks to the outlook. I think our view has been that at this point, what's been done to date looks manageable for the U.S. economy, and then by extension for Canada, because a lot of our exposure to bilateral U.S. and China trade tensions kind of comes via any potential weakening in the U.S. economy spilling over into Canada. So I think everything looks manageable at this point, but we're kind of cognizant that there's a lot of room for things to potentially get worse. And then domestically, there's still the issue. Household debt levels in Canada are very high, and even with central banks kind of moving to the sidelines in terms of the rate hiking cycle, we still expect debt servicing costs to rise over time. That'll slow consumer spending growth, and underlying all of that is, we're still at a pretty mature point in the economic cycle in Canada. So the unemployment rate is very low. Businesses kind of overwhelmingly in most of the country report labor shortages as the largest impediment to growth right now. And none of those issues are going to go away even if trade concerns are resolved all of a sudden. So you end up with a kind of benign trend-like pace of growth in our forecast, which again I think would be good at this point, because when you're already at a pretty good spot, which is where we look for the country as a whole, then it's okay if you kind of stay there, which is what our forecast is. But we're cognizant that there are some risks on the downside as well, and probably more risks on the downside than the upside at the moment.
So domestically, we all know this year will be an election year, and do you think that will affect the economic situation of Canada?
Yeah, I think it could. Certainly, if you got a big move to balance the federal budget, shrink deficits more quickly than we expect, that can be a short-run headwind to growth. But I don't know that that's our base case. So we don't typically changes in government do not have a dramatic impact on underlying economic growth trends.
Yeah. So in the Chinese community, people are worried about the relationship between Canada and China. Do you think that will, now the relationship is in almost the 0 point? So do you think that will affect the Canadian economic situation heavily?
I think our exposure directly to China in Canada is limited. China's our second largest export market, but China still accounts for just 5% of Canadian exports. So direct trade relationships are just not that large. But there are spots that can be impacted. I think we've seen that already with the effective ban on imports of canola into China from Canada. So you can have parts of the economy that get hurt, but those sectors that are vulnerable are just not that large a share of the broader macro economy. So some sectors, industries are vulnerable, but we wouldn't expect significant spillovers to the broader kind of macroeconomic backdrop. There is always the other risk is always getting hurt via the U.S. So if the trade war between the U.S. and China results in significantly more economic weakness in the U.S. than we expect, it would be hard to see that not spilling over to Canada.
Mm-hmm.
Yeah.
So the Chinese people like to do the investment in the real estate market. So what do you predict the situation in that area?
Yeah, I mean, I think our forecast is pretty benign for housing markets in a lot of the country, and that would include Toronto. So we've had a significant slowing in housing markets, including in some place like Toronto. But for a lot of the country, that slowing was from a level of activity that was really much too strong to be sustained in the longer run. So what we've seen is price growth go from being unsustainably high to really flattening out at something close to zero, and that's probably not a bad thing. It's kind of what we expect to see ongoing. There are exceptions. Vancouver's market has softened more than other markets in Canada, and if you resales are still at levels that probably mean prices need to fall further still in Vancouver than they've fallen. But on the flip side, other regions are still growing quite strongly. So someplace like Ottawa and Montreal have been seeing significantly stronger price gains, and we don't see a whole lot out there to say that that those trends are going to change either.
So today, the central bank keep the interest rates stable, not changed. So do you predict that in the near future that the central bank will lower the interest rate?
Yeah, we still think that the next move in interest rates in Canada is more likely to be up rather than down. But we don't expect that to happen, anytime this year or next year. So even today, the Bank of Canada was highlighting again that the domestic economy actually looks a little better than they expected in their last policy decision. They, kind of like us, think that near-term risks are going to be manageable, but they also know that there are risks out there, and so I think their view has been that there's no reason to rush ahead and hike interest rates when risks are out there, and the inflation data has really been pretty benign. So there's no evidence that inflation risks are coming unhinged on the upside. There's really nothing preventing the Bank of Canada from holding steady on interest rates. But we still don't think we've seen enough economic weakness to justify a rate cut either.
Thinking about all the elements which will affect the growth of Canadian economy. So do you have any suggestions for the investors who can manage their, all wealth?
Yeah, I mean, for the from the economics perspective, I think the economy still looks okay. And that's why we end up with kind of a benign economic forecast. The one thing to remember is that we are at a pretty mature point in the economic cycle, and it's tough for things to get a whole lot better from an aggregate labor market perspective than they are. And that just means that there are more things that can go wrong on the downside than can go right on the upside. So that's one thing to remember. But it's when we look out at kind of the risks we can identify for the next year and a half, all of them at this point still look manageable. So we end up with kind of a benign growth forecast where the Canadian economy still keeps doing pretty good, all things considered, at least not getting worse, but kind of with the knowledge that at this point in the economic cycle, there are probably more risks on the downside than the upside.
Okay, thank you so much.
Sure, thanks.
Okay.